You know, with the Fed meeting this week and $83 billion in coupon supply starting out today with 3-year, then 10s and 30s, Monday, Tuesday, Wednesday, a couple of different areas are underscored. Primarily, it's debt and deficits, of course, but the notion of the dollar and how strong it's been. Consider that at the end of last year, we were just a little bit above 92. So basically, we're about 96.5. We're up about 4%. But that isn't really the whole dollar story. As a matter of fact, at the beginning of the year, when rates came out of the chute really hot, and so did the equity markets until we had that period of volatility in February, the dollar, well, it started to plummet. As a matter of fact, its low of the year, around 88.5 in February. If you consider that we are up close to 10% from that level, that's probably a better gauge as to how the effects of a strong dollar and a global economy saturated with debt, with the world's premier central bank on a tightening removal of stimulus normalization plan, well, it shouldn't be any shock that the dollar is strong. We know logistics get in the way, big positions and how they're accumulated in the conventional wisdom of, well, the dollar has to be strong, might have put it down there at the lows in February, but the way it's come back underscores several dynamics. First of all, we hear a lot about inflation, especially after the big wage number that we just had in the employment report Friday. But as we've learned from very sharp economists like Ed Lazier, that just because wages are going up, it's not a foregone conclusion that they end up in the bucket of inflation. That productivity and other global issues and domestic ones with regard to how we assimilate that working force back into the workplace and what type of productivity levels arise can mitigate many of those factors. Another issue is that strong dollar in a consumption economy like the U.S. will help keep that inflation at bay. Now, we can't prove a negative here with respect to counterfactual, so we don't know what the alternative course would have been. But all things being equal, the trade war that many are nervous about that most likely will result in a positive outcome hasn't had the effect on some of the numbers that many thought. And I think the strong dollar plays into that, along with behavior that is changed to deal with tariffs before they actually hit. But in the end, consider LGFVs. These are legal local government funding vehicles in China. The size of these may be as much as $7 trillion US dollars. Why do I bring it up? Because a lot of how tariffs get resolved and how the government deals with debt in China is most likely going to help their currency, which will be a big down at some point in the future for the dollar index.